Every single thing you were taught about money, minus saving, working hard, playing it safe, minus, was designed by someone who didn't want you to win, while you were putting money in a savings account, earning 0.01%. The people who wrote the rules were quietly moving their wealth somewhere else entirely. This isn't a conspiracy theory, minus this is documented, provable, and happening right now, and most people will go their entire lives never knowing it. The financial system you live inside was not built for you, minus it was built around you to extract value from your labor while keeping you just comfortable enough not to question it. Think about the last time someone truly wealthy told you exactly how they built their fortune, minus not the motivational version, but the real, technical, step-by-step version. They didn't, because the moment ordinary people understand how money actually moves, the entire illusion starts to crack at the edges. You were told to go to school, get a good job, and save 10% of every paycheck, minus, and that advice, followed perfectly, will still leave most Americans broke by retirement. The average American household carries over $90 inches debt, works 47 hours a week, and retires with less than $50 saved, minus, after 40 years of doing everything they were told. That is not bad luck, and it is not laziness, minus, that is the predictable, measurable outcome of a financial education system designed to produce workers, not wealth builders. The first lie starts in school, where millions of children are taught history, grammar, and basic algebra, minus, but not a single lesson on compound interest. Taxation. That gap in education is not accidental, minus a financially literate population would ask very different questions and make very different decisions with their money. The second lie is the savings account, minus, sold to you as responsible, safe, and smart, minus, while inflation silently eats 3 to 7% of its value every single year. Keeping your money in a bank account doesn't protect it, minus it slowly transfers your purchasing power to institutions that lend your dollars out at 10 times the rate they pay you back. Banks take your deposited money, lend it to someone else at 7, 10, or even 24% interest, and hand you back 0.5%, as if they did you a favor. This is called fractional reserve banking. It is completely legal, and it is one of the most quietly powerful wealth transfer mechanisms ever invented. The third lie is the 400 wonk, presented as a retirement gift from your employer, minus, but read the fine print, and you'll find fees, restrictions, and market exposure your employer never bothered to explain. Over a 40-year career, hidden fund management, fees averaging just 1%, can silently drain over $150 from a standard retirement account, minus money that leaves your future without a single headline. The people managing your retirement fund collect their fees, whether your account grows or shrinks, minus, which means their financial incentive and yours are not actually aligned. You were told the stock market always goes up over time, minus, but no one told you that the timing of when you retire relative to a market crash can permanently alter the quality of the rest of your life. Sequence of returns risk is a real, documented phenomenon that has quietly devastated millions of retirement plans, minus, and it was never once mentioned in the financial advice you were handed. The fourth lie is homeownership, minus, the cornerstone of the American dream, minus, sold to every generation as the safest, smartest investment a regular person could ever make. But when you factor in mortgage interest, property taxes, insurance, maintenance, and opportunity cost, the average American home returns far less than the real estate industry ever advertises. $300,000 home purchased with a 30-year mortgage at 7% interest will cost you over $715 by the time the final payment clears, minus, and most people never do that math before signing. You were sold a dream, handed a contract, and celebrated for taking on the largest debt of your life, minus, while the bank quietly locked in 30 years of guaranteed income from your paycheck. The fifth lie is that working harder is the path to wealth, minus, a belief so deeply embedded in American culture that questioning it feels almost unpatriotic. Time is the one resource that cannot be manufactured, borrowed, or replenished, minus, and a system that trades your time for a fixed hourly rate has already placed a ceiling above your head. No matter how talented, disciplined, or relentless you are, a salaried income has a mathematical ceiling, minus, and the people who built that ceiling are collecting income while they sleep. The wealthy don't primarily earn money through labor, minus. They earn it through ownership, and that single distinction separates two entirely different financial realities. Assets generate income without requiring your presence, minus a business, a rental property, a royalty stream, minus in building those. Assets is the conversation no one in your school ever started. The sixth lie is that taxes are equal, minus that everyone plays by the same rules and pays their fair share into the same system that funds roads, schools, and hospitals. The United States tax code contains over 70,000 pages, minus, and buried inside those pages are legal strategies, deductions, and structures that are exclusively accessible to those with accountants, attorneys, and existing capital. A W-2 employee pays taxes on every dollar earned before they spend a single cent, minus, while a business owner can legally spend first, deduct those expenses, and only pay taxes on what remains. That structural difference in how income is taxed is not talked about in schools, not explained by most employers, and not visible, unless someone who already knows shows you where to look. The seventh lie is that the stock market is a level playing field, minus where any individual investor with a brokerage account competes equally alongside institutional giants. High-frequency trading algorithms execute millions of transactions per second, econ, moving markets in fractions of a millisecond, minus operating at a speed and scale no individual investor can see, match, or react to. The information that moves markets, minus earnings, calls, merger negotiations, policy decisions, minus reaches institutional desks, hours, sometimes days, before it reaches the financial news. Your phone shows you. By the time a trending stock tip appears in your social media feed, the people who position themselves for that move have already entered, profited, and in many cases quietly exited. The eighth lie is that financial advisors work for you, minus that the person sitting across the table with charts and projections has your retirement as their first and only priority. The majority of financial advisors in America operate under a suitability standard, not a fiduciary standard, minus meaning they are legally permitted to recommend products that benefit them, as long as those products are merely suitable for you. Understanding the difference between a fiduciary and a suitability advisor is one of the most financially important pieces of knowledge a person can have, minus, and it is almost never volunteered by the advisor in the room. By now, a pattern is emerging, minus, and it is not subtle once you see it, minus every lie you were handed came wrapped in the language of safety, responsibility, and common sense. The most effective financial traps in history were never sold as traps, minus they were sold as wisdom, passed down from generation to generation by people who genuinely believe they were helping you. Your parents didn't mislead you on purpose, minus they passed on the exact blueprint they were given, in a system that updates its marketing, but rarely updates its rules in your favor. The ninth lie is that credit scores measure financial health, minus that a 3-digit number is an accurate reflection of how well you understand and manage your money. A credit score does not measure your savings, your assets, your income, or your net worth, minus it measures how reliably and how frequently you borrow money and pay it back to lenders. A person with zero debt, $200, 0 inches savings, and no credit cards can have a worse credit score than someone drowning in loans who never misses a minimum payment. The credit scoring system was designed by lenders, is maintained by lenders, and rewards behaviors that generate fee income for lenders, minus which tells you exactly whose interests it was built to serve. The 10th lie is that inflation is an unavoidable natural force, minus like weather or gravity, minus something that simply happens to the economy and affects everyone more or less equally. Inflation is a policy outcome, minus it is the measurable result of decisions made by central banks, treasury departments, and legislative bodies, minus decisions that are debated, voted on, and implemented by human beings. When governments print trillions of dollars to stimulate an economy, the purchasing power of every dollar already in your savings account quietly shrinks, minus transferring real wealth from savers to those who hold hard assets. The people who understood that dynamic in 2020 moved their money into real estate, equities, and commodities before the inflation wave hit minus, while most Americans watched their grocery bills rise and wondered why. This is not speculation minus. It is the documented, measurable history of every major inflationary period minus, and the divide it creates between asset owners and cash holders widens every single time. The 11th lie is that the news gives you the financial information you need, minus that watching market coverage or reading headlines keeps you informed enough to make smart money decisions. Financial media is not an educational service, minus it is an advertising platform, minus and its revenue depends on keeping you emotionally engaged, not financially empowered. Fear drives clicks, urgency drives subscriptions, and complexity drives the feeling that you need an expert. And all three of those emotions are far more profitable to media companies than your actual financial literacy. The 12th lie is that entrepreneurship is only for exceptional people, minus for the rare visionary genius with a revolutionary idea and the fearlessness to risk everything on a single bet. The vast majority of successful small business owners are not geniuses, minus they are ordinary people who identified a repeatable problem, built a simple system to solve it, and showed up consistently long enough for compounding to work in their favor. The barrier to entrepreneurship was never talent, minus it was the repeated message that business ownership was risky, complicated, and reserved for a special class of person that most people were told. Implicitly, they were not. The 13th lie is that investing is complicated, minus that the math, the terminology, and the risk are simply too advanced for someone without a finance degree to navigate responsibly. Index fund investing, dollar cost averaging, and tax-advantaged account structures are concepts that can be explained clearly in under an hour minus, and mastered with discipline in under a year. Minus, yet they remain invisible in mainstream education. At this point, you may be feeling something between anger and disbelief, minus, and that reaction is completely rational, because what you are realizing is that the gap in your financial life was never about effort. The most painful part of this truth is not that the system exists, minus it is that millions of people blame themselves for outcomes that were structurally engineered long before they ever made a single financial decision. A person who grew up without financial mentorship, in a household living paycheck to paycheck, was already behind before they ever opened their first bank account, minus, and no amount of personal discipline fully closes a gap created by missing information. The 14th lie is that wealth is primarily inherited, minus that if you were not born into money, the window for building real financial security has already quietly closed behind you. Generational wealth is real, and its advantages are significant, minus, but the fastest growing segment of high net worth individuals in America today consists of first-generation wealth builders who start with nothing but a different set of financial frameworks. The difference was not luck, connections, or starting capital, minus it was the moment they encountered information that reframed what money actually is, how it actually moves, and what it is actually capable of doing. Money is not a reward for hard work. Minus money is a tool, and like every tool, its power depends entirely on whether you understand its mechanics, or simply hand it to someone else to operate on your behalf. The 15th lie is that financial stress is a personal failure, minus a private shame, to be hidden from colleagues, and even family, minus, rather than the predictable output of a system with a broken instruction manual. Over 60% of Americans report that financial stress is the single biggest source of anxiety in their daily lives, minus yet, the solution is almost never discussed in the same spaces where that anxiety is felt most intensely. Silence around money is not modesty, minus it is a cultural condition that has been quietly profitable for every institution that benefits when you make uninformed financial decisions in isolation. The 16th lie is that time in the market always beats everything else, minus that patience alone, without strategy or structure, is sufficient to build lasting financial security across a lifetime. Time in the market matters enormously, minus, but the account type, the fee structure, the tax treatment, and the asset allocation sitting beneath that investment determine whether that time translates into freedom or merely a number on a screen. Two people can invest the same amount for the same number of years in the same general market, minus, and end up with retirement accounts that differ by hundreds of thousands of dollars based entirely on structural decisions made in the first year. The 17th lie is that budgeting is the foundation of wealth, minus that tracking every coffee and cutting every subscription is the primary mechanism through which ordinary people build extraordinary financial lives. Budgeting is a survival tool, not a wealth tool. Minus, it prevents financial hemorrhaging, but it cannot replace the income gap created by a system that pays labor a fraction of the value that labor actually generates. You cannot cut your way to wealth in an inflationary economy. Minus, at some point, the only mathematically viable path forward is to build or own something whose value grows faster than the cost of living rises around you. The 18th lie is that the wealthy take enormous risks, minus that the gap between your financial life and theirs is simply a matter of how much danger they were willing to accept that you were not. The ultra-wealthy are actually among the most risk-averse people on Earth. Minus, they use legal structures, diversification, insurance instruments, and asymmetric bets to protect capital first and grow it second. The risk tolerance narrative was sold to ordinary people to justify speculative behavior on one end and paralyzed inaction on the other. Minus, while the actual strategy used by the wealthy quietly operates in the space between those two extremes. What separates the financial outcomes of the top 1% from everyone else is not boldness, brilliance, or birthright. It is access to a different set of rules, applied consistently, over a long enough period of time. Here is where the story shifts. Minus, because understanding the lie is only half the equation. And awareness without action is just a more sophisticated version of being stuck. The moment you stop measuring your financial progress by how much you earn and start measuring it by how much you own, something fundamental changes in every decision you make with money. The first move is not dramatic. Minus, it is not quitting your job, launching a startup, or betting everything on a single investment. Minus, it is simply learning to see every dollar as a potential employee rather than a reward to be spent. Every dollar you direct toward an income-producing asset works 24 hours a day, requires no health insurance, never calls in sick, and compounds its output silently while you sleep, eat, and live your life. The second move is understanding your actual tax situation. Minus, not the simplified version your employer handed you. Minus, but the full landscape of legal deductions, structures, and strategies that are available to anyone willing to learn them. A single conversation with a qualified tax strategist. Minus, not a seasonal tax preparer, but an actual forward-looking tax planner. Minus, can identify legal savings that dwarf the results of a year's worth of aggressive budgeting. The third move is separating your identity from your income source. Minus, because as long as your sense of security is tied exclusively, paycheck from a single employer, your entire financial life rests on one relationship you do not fully control. Building even one additional income stream, minus a skill, monetized online, a small rental income, a dividend-paying asset, minus begins to structurally change your relationship with financial risk in ways that no savings rate alone can replicate. The fourth move is ruthless financial education. Minus, not the motivational content that makes you feel temporarily inspired. Minus, but the technical, specific, sometimes uncomfortable knowledge of how money, taxes, debt, and markets actually function. Read the books that wealthy families give their children. Minus, study the tax code sections that govern business deductions. Minus, understand the difference between earned income, passive income, and portfolio income, because the IRS taxes all three very differently. The fifth move is community. Minus, because financial transformation almost never happens in isolation, and the single fastest way to change your financial trajectory is to spend serious time around people who are already operating by a different set of rules. Your financial average tends to migrate toward the financial average of the 5 people you spend the most time with. Minus, which means that access, proximity, and environment are not soft motivational concepts. They are hard financial variables. The system was never going to teach you this. Minus, schools won't, employers won't, and most financial institutions have a direct commercial interest in you remaining just informed enough to participate, but not informed enough to truly compete. But here is what the system could never account for, minus the moment. A critical mass of people share this information freely, openly, and repeatedly. The informational asymmetry that powers the entire machine begins to erode. You are not behind because you failed, minus you are behind because you were handed an incomplete map and told it was the whole territory. And the most powerful thing you can do right now is demand. The real one. The financial lie you believed your whole life was never about one specific product, one specific institution, or one specific policy. Minus, it was the cumulative effect of 100 small misdirections, each one individually reasonable, collectively devastating. Every year you operate inside a broken framework costs you something real. Minus not just in dollars, but in options, in time, in the version of your future that becomes slightly less possible. With each passing quarter, the people who broke free from this system did not find a secret, win a lottery, or stumble onto some hidden opportunity. Minus they simply decided, at a specific moment, that the discomfort of learning the truth was smaller than the cost of remaining comfortable in the lie. That moment can be right now, minus this video, this information, this specific realization that the rules of the game are learnable, the gaps are closable, and the window has not shut, minus not for you, not today. Share this with someone who needs to hear it, minus, because the most powerful thing money can do is not sit in an account or grow in a portfolio. Minus it has changed the way a person sees the world, before it is too late to act on what they now know.